please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Well, the IPO for IRCON International opens today with a price band between 470 to around 475. Anisha, tell us about this particular deal. There'll be divestment, right, from the government?
Well, yes, this is basically an OFS wherein the government is looking to offload around 10% stake in the company. As you mentioned, the price band is 470 to 475, giving it an expected market cap of close to around 4,700 crore rupees. In terms of the details, well, as I mentioned, the government might have a stake of around 89.2% after this particular divestment by them. And the company is a mini Ratna actually, and the core business of the company is infrastructure development as well as construction. Now, primarily they focus on the railway segment and they have exposure both in the domestic market as well as the international market, and their services include the likes of design and engineering of the project as well as procurement of the equipment and packages. And also remember the fact that they get most of the business from the government. Around 75% of their orders actually come from government on a nomination basis, and this is one of the positives as well, given the fact that they have a steady inflow of these orders coming in from the government, and that's the reason their order book actually grew at a robust CAGR of around 13% in the last 2 to 3 years. Now, their book-to-bill ratio stands at around 6 times the FY18 numbers, giving it a clear visibility of the next 5 to 6 years. They are present in a lot of geographies. They have a large client base as well, and that is a bit of positive. In terms of the segments, as I mentioned, railways actually contribute the most. 87% of the business actually comes from the railway segment, and as you can see, the likes of highway and electrical works form around 5%. In terms of the other positive, well, it is a net debt-free company and has a lot of cash of around 1,200 to 1,300 crores on the book, and they already receive a part of their project costs and advances. So no issue regarding to the working capital, and given the structure of the business, that remains a major concern. But given the fact that they receive it in advance, no major concern coming in there. In terms of the risk and concern, well, first up, as I mentioned, they get around 75% of the business from the government. That creates a bit of a risk in case there is some change in the policy or the nomination basis goes away. Then the company's a stronghold on this particular segment might just be taken back. Other than that, they have a concentration on the railway sector of around 85%, so that is a bit of risk as well. There have been some issues that have been raised by the statutory auditors, some vigilance issues, and that might just be a bit of overhang on the stock. And like most of these companies, they have a lot of legal proceedings on them, so that is again one of a bit of a negative. In terms of how they have performed financially, well, over the last 2-3 years, they have grown their revenue at a rate of around 30%, and that is a bit of positive, though the profit has been more or less stable at around 411 crores. Other than that, Nigel, if you look at the valuations, they are very competitive when you compare it to the likes of NBCC, EIL, RITES, the other government-based companies, and hence most of the brokerages that I looked at have a subscribe call, whether it is ICICI, Antique, Motilal Oswal, etc. So the expectation is that the interest would be high for this one. Let's see what the numbers look like.
Well, we'll keep an eye out on this one, but for the time being, I'll also keep an eye out on the SGX Nifty. That's moved to the low point of the day. It's indicating a downtick of close to around 50 to around 55 points odd. Some of these IPOs, timing the IPO is very, very important, because if the market gets into a bit of a tizzy, then it'll be hard to see a lot of money get moving to some of these IPOs. For the time being, SGX Nifty intraday chart will tell you the picture. When we started off the show, it was indicating a 30-point downtick. Now it's indicating a 55-point downtick just to kickstart trades.
Let's take a look at what's happening in the world of commodities, and Manisha Gupta as always joins us with the update. Manisha, good morning. Tell us more.
Hi, morning, and thank you so much for that. But it really is about the US dollar, which is strengthened yet again, putting pressure on commodities. And the other major news, of course, is a huge possibility of the US actually imposing further tariffs on $200 billion worth of Chinese goods as early as today. So that really leads to demand estimates being lowered, and that you would see most of the commodities trading weaker because of that. So metals, precious metals, crude oil prices, everything is opened Asia on weaker note today. For the crude oil prices, it also is about the global data that came in the previous week showing an increase in supplies. That is weighing on to the crude oil prices. The U.S. also has added a couple of rig counts, and that would tell you that there is an expected increase in U.S. production also. So that's yet again weighing onto the market. Having said that, there's plenty data apart from that also coming in. You have the ECB Mario Draghi press conference tomorrow. The markets also are looking at the US and Chinese data coming in today. So there's plenty to see a reaction to. But Asia definitely has started with a lot of caution, depending on what the US could do in sense of trade with China.
Okay, all right, Manisha, thanks so much for that. Well, I'll tell you all the cues that are coming in from the derivatives market. First up, take a look at the SGX Nifty. That's indicating a 50-point downtick. I don't think there'll be too many who took short positions getting into this event. So, you know, the trade rally setup is going to be quite interesting just to kickstart trade. Remember the last couple of trading sessions or the last 1.5 trading session, the Nifty's seen a big rally from the lows. The Nifty Bank as well has jumped up nearly around 600 points odd. And, you know, if someone told you that there were not many expectations over the weekend, I don't know how much to believe them, because the FIs, they went into this event backing up the markets. They bought close to around 1,000 crores approximately, and you didn't really want to take a short position getting into this event. And that's why we saw unwinding both on the Nifty futures open interest, that was down nearly 2%. The Nifty Bank open interest, well, that was down nearly around 15% approximately. So a lot of covering of shorts is what we saw in the last, in Friday's trading session. And that's why the Nifty got up and going and ended virtually at the high point of the day. If you're looking at the FIs, well, they unbound close to around 8,000 odd short contracts on the index futures. The FIs, now they're net short on the index. But in Friday's trading session, they covered those shorts. They said, let's not take a risk. Let's lighten the short positions. The interesting part will be, today, do they pile on the shorts yet again? Or at some point of time, do we see some short covering as well? Clearly at the top, though, there were some market participants that said, let's go ahead and take some short positions. And that's perfectly depicted in the premium on the Nifty futures, because that's come down to around 32 points from nearly around 50 points approximately. On the options end, the FIs, they bought calls. You know, if things really went right and we really got some big bang measures, then they would be making some money on those calls. So interesting to see whether or not they unwind those calls now. And in fact, on the put side, they've got a lot of protection on the put side. But in Friday's trading session, they unwound some puts. You don't want to be writing calls getting into an event like this, let alone shorting the index. And that's why we did see some unwinding on the short contracts that were written. That's the calls that were written, as well as some puts that were written as well, did see some unwinding. Overall, the FIs have bought more puts than calls. So if things go wrong, you have protection on the downside, which is not such a bad thing. And also they've written more puts than calls, telling you that they don't expect the market really to tear apart or really crack down. That's why they're writing some puts as well. The key level you need to look at for the bulls, 11,250. That's the level from where we did see a bit of a bounce. So the bulls will believe, yes, we can defend that mark. Morning tick lower. So let's see whether or not, we see some follow through out there, or can we see some short covering from those lows. There's a bit of a disappointment, though, that's playing out, Anisha.
Okay, so the SGX Nifty is suggesting a start 50 points lower, but the downside still looks protected. Let's take a look what the Asian markets are doing. The Hang Seng was down about 1.6%. Remember, the typhoon there has wreaked quite a bit of havoc, and that's the reason the Hong Kong market was edging lower. Let's pull up what the other Asian markets are doing, because SGX Nifty is suggesting a downtick of around 50 points. Let's see whether the other Asian markets are also trading lower. Nikkei is, of course, closed for the day. That's why it's showing the wrong rates of Friday. Shanghai is down about almost 1%, and Hang Seng has actually extended the cut. It is now down about 450 points. So weakness persisting across Asia. Remember, the handoff from US was also a tad bit mixed. There were no major cues that really supported the markets there, and the trade tensions seem to be escalating a tad bit. As the government battles a falling rupee and rising fuel prices, the Prime Minister held an internal meeting with the Finance Ministry officials and took a review of the various departments of the Ministry of Finance. Now, this after the government announced 5 steps aimed at bringing in the much-needed dollar inflows. Prime Minister Modi expressed his satisfaction with the economy and macroeconomic data emerging this year. Let's take you through the 5 measures that were announced by Mr. Arun Jaitley on Friday. Number 1, the government will review mandatory hedging condition for infrastructure loans. It has also been decided to permit manufacturing entities to avail the external commercial borrowing facility with minimum maturity of 1 year instead of the earlier limit of 3 years. Thirdly, restrictions will be removed with respect to FPI exposure limit of 20% in the corporate bond portfolio to a single corporate group or a company or entity, and 50% of any issue of corporate bond. In fact, with regards to the masala bonds, the government has decided to do away with the withholding tax on bonds issued till March 2019. And finally, restrictions on Indian banks on marketing and underwriting of masala bonds would be removed. Well, moving on, let's hear out what the Finance Minister Arun Jaitley had to say after the meeting with the Prime Minister.
The government is confident and will strictly maintain the 3.3% fiscal deficit target. As far as the capital expenditure is concerned, which is quite necessary for the purposes of maintaining a high trajectory growth, already we have spent about, till 31st August, 44% of the budgeted expenditure. And we'll end the year without any cuts and will maintain the 100% capital expenditure because that's extremely necessary for maintaining the growth rate. The government is confident that we will have a growth rate higher than what we had projected earlier this year in the budget. The inflation is broadly under control. With regard to the GST and the other indirect taxes, the GST is settling down, and with the kind of pickup in consumption which has taken place, it obviously will have an impact on GST collections in the future months. And we are quite confident that between the direct and the indirect tax collections, the government would comfortably meet the target, if not surpass it. As far as non-tax revenues are concerned, the entire program of divestment and strategic sales for this year was also considered. And just as we exceeded the target last year, we are confident of not only maintaining the disinvestment target this year, but may perhaps be in excess.
Okay, there the Finance Minister confident of maintaining the fiscal deficit target. In fact, post the announcement of these measures on Friday, Economic Affairs Secretary S.C. Garg told CNBC TV18 that the measures are expected to have an impact to the tune of $8 to $10 billion. Here's a quick snippet of that exclusive conversation.
In the present circumstances, at the current level, going beyond what we witnessed last few days was enough to consider something at which there has to be
so 73 in that sense is the threshold then, if I can ask you bluntly.
I wouldn't specify any particular number,
okay.
But the reason that there's been a discussion, review of the situation when it reached a certain level would indicate that the government would consider anything around that or beyond that to be unreasonable levels. These 5 measures would definitely have meaningful impact. It might, it's difficult to put any specific number, but I think it should have impact of about $8 to $10 billion. There is a constant review, especially on the current account side, exports and imports measures. Those would be, as I said, reviewed next week or something. So there would be a constant decision-making, taking into account the situation, and specific measures would be announced by the government.